What is vulture investing? The secret way to make money from failing companies. Welcome to episode 1 of the Art of Vulture Investing. In this video, we're going to talk about something that sounds a little strange. Vulture investing. Let's start with the name. You may have seen vultures in the wild, large birds that feed on dead animals. It sounds unpleasant, but in the world of money, the name vulture investor means something different. A vulture investor is someone who looks for companies that are in big trouble, even companies that are going bankrupt. These investors try to buy the company's debt or shares at very low prices, and later try to make a profit when the company gets better or is sold. Let's break it down step by step. What is vulture investing? Vulture investing means buying things called distressed securities. These are stocks or bonds of companies that are in serious financial trouble. Sometimes these companies are already in bankruptcy. Most people would run away from these kinds of companies. But vulture investors do the opposite. They go in, do deep research, and try to find out if there's a way to make money from the situation. These investors often buy debt, that's money the company owes, at very cheap prices. For example, they might buy a bond for 20 cents that used to be worth $1. If things go well, they might later sell that bond for 60 cents or even more. That's a big profit. Simple example. Let's say a big hotel company is losing money fast. Everyone thinks it's going to shut down. Its bonds, which are like IOUs, are now selling for a very low price. A vulture investor comes along and buys those bonds for cheap. Then the company enters bankruptcy, cuts its costs, and slowly gets better. Now the bonds are worth much more. The investor sells them and makes a big profit. This is how vulture investors work. They take big risks, but if they're right, they can earn a lot of money. Where did this strategy come from? Vulture investing became popular in the 1980s and 1990s. At that time, many companies were using too much debt, and some started failing. Smart investors saw an opportunity to buy that debt at a low price and make money when things changed. Some famous vulture investors include Carl Icahn, Paul Singer, and George Schultze, the author of the book we're using for this series. These people made millions, even billions, by using this method. Why do companies get into trouble? There are many reasons. Bad leadership, too much debt, changing technology, the economy getting worse, lawsuits or scandals. When a company is in trouble, it might not be able to pay back its loans or keep running. That's when it enters distress, and its bonds or shares drop in value. That's when vulture investors get interested. How do vulture investors make money? There are 3 main ways. Buy low, sell high, buy bonds or stocks of a troubled company for a low price. Sell them later when the company recovers. Take control in bankruptcy. If they own enough of the company's debt, they can take part in bankruptcy court decisions and try to control how the company is fixed. Sell the company's assets. If the company can't be saved, the investor might get money when its buildings, equipment, or land are sold. Is this legal and fair? Yes, it's legal, but it's not always popular. Some people think vulture investors are cold or greedy because they make money when other people lose jobs or when a company shuts down. Others say these investors actually help by fixing broken companies and saving some parts of them. Without vulture investors, some companies might just disappear and leave nothing behind. Why vulture investing is hard? This type of investing is not easy. It takes a lot of research, knowledge of bankruptcy laws, patience. It can take years to make money, courage to take big risks. George Schultze explains in his book how he spent hours reading legal papers, studying financial reports, and even attending court hearings before making a decision. What you will learn in this series. This is just the beginning. In the next episodes, you will learn the mindset of a vulture investor, how to spot opportunities, what happens inside a bankruptcy court, real-life case studies like Enron and Delphi, how regular people can learn from these strategies. Final thoughts. Vulture investing is not for everyone, but it shows us a different side of the financial world. It's about finding value in crisis. It's about using intelligence, courage, and strategy to turn disaster into opportunity. This is how some of the world's richest investors built their fortunes. So if you're curious about the secrets of big money and want to understand how financial recoveries happen, keep watching this series. What's next? In episode 2, we'll talk about the vulture investor mindset. What kind of thinking and personality is needed to take these risks and see opportunity in chaos? Make sure you like, comment, and subscribe to follow along. Thank you for watching episode 1 of the Art of Vulture Investing.